Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Wednesday, July 16th. The headlines summarizing Intel's second quarter earnings report sounded good at first blush. Intel topped estimates by 3 cents. Intel reports record second quarter revenue of $9.5 billion. They were what you hoped they would be as a shareholder, but closer examination reveals they weren't all they were made out to be. Yes, Intel topped estimates, but it did so aided by a lower share count, a lower than expected tax rate, and lower than expected restructuring and asset impairment charges. Had the tax rate and restructuring charge been matched with the company's prior guidance, earnings per share would have been in line with the consensus estimate of 25 cents. Note, though, that buyback activity added about a penny to the EPS number. The Q2 gross margin rate of 55.4% was a bit weaker than expected too, as demand for lower-priced notebook PCs resulted in lower than expected microprocessor average selling prices. To sum it up then, the second quarter for Intel was more of an okay quarter than a stellar one, as the initial headlines might have led one to conclude. That realization is a reason why the stock has not reacted more favorably to the upside surprise. On a related note, Intel's third quarter guidance was reassuring. The company expects to deliver revenue in the range of $10 billion to $10.6 billion. The midpoint of that forecast is comfortably above the current Thomson Reuters consensus estimate of $10.07 billion. Q3 gross margins are anticipated to be 58%, plus or minus a couple of points. Its full-year gross margin rate expectation was left unchanged at 57%, plus or minus a couple of points, as was its CapEx forecast of $5.2 billion, plus or minus $200 million. The company's conference call conveyed an upbeat outlook. Management stated demand continues to be healthy across products and geographies, that inventory levels are in good shape, that it has seen robust demand for its Atom product, and that costs should improve dramatically versus the second quarter, as its 45-nanometer manufacturing process is lowering unit costs at a better than expected rate. In the current environment, though, the market is inclined to take the position that it will believe it when it sees it. The fear or the perception that global economy will slow and prevent Intel from meeting expectations is acting as a hindrance for the stock. Until the market adopts an improved outlook for the global economy, Intel stock will likely find it difficult to sustain a material advance. We would not be sellers of the industry leader at current levels, but those holders unwilling to accept the prospect of near-term volatility in the issue may wish to reduce their holdings in the chipmaker. I'm Pat O'Hare for Briefing.com. Thanks for listening.